So my first prediction is that interest rates will stay high, and I want to be clear when I say that. I'm comparing what I believe will happen in interest rates to what the market is now pricing in, and it's changed quite a bit, the market expectation in the last month. And so a month ago, if we had done this webinar, the 10-year note yield was around plus or minus 5%. And of course, the Fed funds rate hasn't moved. It was 5.25. It's remained 5.25, but the expectation of where Fed funds would be over time was keeping Fed funds much higher for longer a month ago. And where you really see that manifest is in the 2-year note yield, because at the end of the day, the 2-year note yield is nothing more than the sum of each month of Fed funds. And it's the average of those. And if you looked at the 2-year note yield a month ago, it was plus or minus, it got as high as the low fives to around 5%. This morning, it's around 4.6. And so the big change in the market expectation is that now they believe there's going to be rate cuts, and they believe it's going to be relatively quickly, somewhere in the neighborhood of 75 to 100 basis points in 24. That's the market expectation. The 10-year note has also come down from around 5% to today. It's as low as, I believe, 4.12. I just checked. So a lot. I mean, if you think about as a percentage basis, the 10-year note yield is down, 16, 17% in a month. Think about if the stock market went up or down 17% in a month. I mean, that's unheard of, but yet it happened in interest rates, and it equally went up as fast the few months prior to that. So there's a lot of uncertainty in interest rates still. You see it through the volatility and the movement. And you see it by what I'm saying, which is I'm less certain for these reasons than I've been in the past. However, excuse me, I believe that the Federal Reserve is more likely to be cautious in starting to reverse their policy from rate hikes to rate cuts. If you go back to the Volcker Fed of the early 80s when they were combating inflation, they made the mistake of stopping the hiking process, and then they had to restart it again when inflation spiked. And I think the Fed today wants to try to avoid that. My bet is it's more like 25 to 50 basis points next year. So big difference. And if you look at the Fed funds rate, you see that we have it over the next year coming down, but we have it coming down to about 5%, 4.75, that range, which is different than the market expectation today. In terms of the tens, similar. In the article, you'll see I talk about rates fluctuating in a range between 3.5 and 4.5. Today we're at 4.12. So I see volatility actually being a bit less, and that's good. That helps the market. We need stabilized interest rates to start the transaction process again. But I also think that it's going to stay a little bit higher than the market expectation. And the reason for that is the inflation rate, which is here, the blue graph. And what's important is the far right side. Obviously, what's before it has already happened. I believe inflation is going to come down. Right now, it's around 3.5. I think it gets to 2.7, 2.8, 2.9, that range next year. However, the market thinks it'll be lower, and the Fed target is 2. And so I think it'll go down, but it'll go down slower than we think. It'll be led by housing, meaning the downward pressure, because housing is measured by rents, and rents have been flat to negative this year, and those leases will reset throughout 24. I also believe, and we'll get to this later, that rents are towards the end of their negative cycle. And I think that will also reverse the inflation in 25 to a more positive inflation. But big picture, there needs to be a real return on bonds. So, for example, right now, the real return on bonds, if you believe inflation is 3.5, and you believe, we know that the yield is about 4.15. There needs to be a real return. So if I'm telling you I think inflation is going to be 2.8, 2.9 next year, let's say the real return needs to be 70 to 100 basis points. I'm telling you that rates are pretty fairly priced here, meaning we need a 10-year yield of 3.5, 3.8, 4, 4.2. These are the ranges we're talking about.